Okay, welcome to First Draft Live. It's Friday, August 1st, and we're coming to you live on what some are already calling Liberation Day Part 3. I'm your host, Mark Bonner, BizNow's editor-in-chief, coming to you live from New York. Thanks for tuning in from all across the country and around the world. I really appreciate your time. Overnight, maybe you saw this news. The White House made a stunning pivot. Just before his self-imposed deadline, President Donald Trump signed an executive order extending tariff negotiations for 7 more days. That gives nearly 70 countries one final shot to cut a deal or face sweeping new import taxes ranging from 15 to 41% starting next Thursday. The move marks a definitive break from decades of free trade consensus. The US is now in a full-blown protectionist era. The fallout? Market shock. The Dow is down more than 500 points this morning. Global recalibration. And for commercial real estate, some very real implications. Steel and aluminum tariffs remain locked at 50%. That's keeping development costs roughly 10% higher. Copper tariffs are also kicking in. Pharmaceuticals and semiconductors, they're next in line. Canada is facing 35%, Switzerland 39%, Brazil 50%. Even close allies like South Korea had to scramble to ink a last-minute deal. Meanwhile, the European Union managed to secure a deal earlier this week, capping tariffs on most goods at 15% instead of the threatened 30%. They were originally in single digits. They are now no longer. And while the Dow continues to hit record highs over the last few months, today being the exception, beneath the surface, this tariff regime is quietly redrawing winners and losers. Big tech and financials are gaining ground with investors, while CRE, everyday consumers like you and me, energy and healthcare are getting the short end of the trade stick. So is CRE heading deeper into uncertainty? With sourcing bottlenecks, capital dislocation, and inflation threats lurking just off stage? Can U.S. protectionism be priced in, or will volatility continue to reign? To help us make sense of it all, we're joined by someone who's been tracking it from the front line since day one. James Bohnaker, senior economist at Cushman and Wakefield, a veteran of S&P Global, CBRE, and Moody's. James, welcome to the show. I know you're calling us from Boston.
Yeah, glad to be here, Mark. Thanks for having me.
Look, man, you've picked one hell of a week to show up on this show, so we really appreciate you. Let's just start right at the beginning. What was supposed to be a hardline deadline today became something different, a pivotal pivot, if you will. Trump's executive order gave nearly 70 nations until August 7th to secure trade agreements. I know for a lot of players on the ground across the United States and in Europe, where we have so many of our audience coming in today, they may think, oh, that's happening somewhere else. That's not affecting my world. What do you think is most consequential for CRE right now, given the news of the last 24 hours?
Well, I think it's a continuation of what we've become accustomed to in this administration in Trump's second term, right? Which is just unpredictability on a policy front, primarily as it relates to trade and tariffs. And the initial shock obviously rocked markets back on April 2nd, and we've just had a constant stream of changes to policy and kind of not knowing what's coming next. So I think that's really the biggest thing right now. We still don't have a lot of clarity as far as policy goes, and I think at the end of the day, while some of these trade negotiations have been favorable in terms of just the tariff rate coming down from a worst case scenario, there's been other countries that have, been worse off than we expected. And I think just, big picture, taking a step back where we are today, the effective tariff rate in the US, which essentially combines all these different rates on countries and products, it's still about 10 percentage points higher today than it was heading into this year. And so that's consequential. That's, a cost increase that, businesses, consumers, developers are going to have to pay. And it's going to take time for that to shake out. And that's really the big question mark for me are, the implications to the US economy, to financial markets, construction costs, all of those things. And, it takes time to work itself through the supply chain. And so I think we're still very much in that period where, not only do we have the tariff policy uncertainty, but you're also starting to see some of this spill into the economic data, right? So we got a jobs report this morning, 73,000 jobs for the month of July. Not great. And if you look back over the prior months, we had some significant downward revision. So economy is clearly slowing. Economy is clearly slowing. Policies unpredictable. And then you talk about the Fed too on the monetary policy side of things. That puts them in a jam. So I don't think there's a lot of clarity out there. There is good news though. I think, heading into this year and still, over the course of the first half, we've seen a lot of resilience across commercial real estate, whether you're looking at leasing fundamentals, we're seeing improvement in debt markets, equity. So there's some green shoots out there, and I think this recovery has some resilience, has some momentum, notwithstanding some of the macro risk that's out there.
So look, there's been a lot of doom and gloom headlines on the macroeconomic agenda, that the U.S. has been trying to face. There's been a lot of geopolitical issues. You talked about the Fed. The Fed held. They're probably not going to lower rates in September, although it's probably a jump ball. Most economists say that the interest rates probably won't start coming down in December, probably going to Q1 26. I mean, you're talking about these green shoots. We've been covering this for months. You are correct. So, how do you make sense of the macroeconomic noise, which a lot of people say is doom and gloom and scary? The jobs report didn't come in as strong as we had hoped. Why are these green shoots sprouting? How is this possible?
Well, I think you have to consider, go back, a few years. Commercial real estate's been in a slump by many regards for a while now, right? Things were going pretty well for the better part of 2022 until we got, the ramp up, significant ramp up in interest rates, right? And being such an interest sensitive sector, we really saw the capital markets ground to a halt. A lot of uncertainty around the office market with obsolescence and more distress coming online. And so we're kind of well into the slump, and the recovery had already started, right? Even if you look across the office sector, there's some absolute green shoots there that we're seeing. And so real estate has kind of already been through its bumpy period. And so I think that with the backdrop of a mostly resilient economy, most of that softness that we've seen in our sector has kind of been worked its way through the system, right? And so I think there's just a ton of capital on the sidelines, both domestically and foreign, that's been parked there for a couple of years now. And so I think there's just that urgency to get back in the marketplace. Remember, real estate is mostly a long-term investment, right? And I think we're very clearly, in many regards, kind of at the bottom of the cycle, or even a bit beyond it. And now looks like a really compelling time to make those investments in commercial real estate from a number of different angles. And so I think the fundamentals for real estate look a little bit better than kind of just looking at the overall macroeconomy right now.
Just getting back to tariffs just for a second. Steel and aluminum are still taxed at 50% as of today. That's keeping development costs elevated by 10% or more. You and I were talking about copper levies earlier. That came in a little lighter than feared. That triggered a plunge in prices after markets had overcorrected. Are developers still in freeze mode today? Or are they going to begin, or can they now begin to model these new scenarios based on fixed rates and these friendlier trade corridors?
Yeah, so we've been modeling this very closely. So just to give you a sense, I know you referenced the 10% increase due to tariffs. By our estimation, we're looking at materials costs based on the tariffs that are in place today, that are about 6 to 7% higher on an aggregate basis across commercial real estate projects, just for the materials. So if you kind of assume that labor is what it is, no changes there, we're only estimating that the project costs are up about 3 to 4% in terms of the exclusive impact from tariffs. So that being said, it's maybe not as bad as some other estimates out there, or you might expect, just given those 50% tariffs. So that's one thing. I think that the costs aren't increasing as much as could be expected. So, but to answer your question, I think it's ultimately a little bit of both, and it kind of runs the spectrum, right? So we've got a development environment, which, if you look at multifamily, industrial, of course, the office market, retail construction has been subdued for years now. So all of these sectors, we're seeing really soft activity, right? Not just because of interest rates, but because of market conditions too. And so, I think there is a sense that developers would like to, mitigate the cost pass through that they pass on to their customers. But I- that's going to be some of it. But the reality is that, these costs increase given what we've seen over the past number of years, right? It's not like construction costs that went up dramatically in 21 and 22. It's not like they've come down. So these are just additional costs in an already tight market in terms of turning a profit on new developments. And so I think to some extent we'll see projects paused or perhaps scrapped altogether. But that's probably the exception rather than the rule right now. I think that for the
Yeah.
most part, developers for projects that are already underway are going to try to make that work. But it is a very tight operating environment right now, and we're just not seeing a lot of new development. And I don't think that we really break out of a slump here anytime in the next couple of months. I think that's probably more of a 2026 recovery period.
Right. I mean, look, this was supposed to be the year where all that sideline capital was then going to re-enter the playing field, coming off of the pandemic and everything that happened during that period of time. Yet, talk about green shoots, the CRE Finance Council Sentiment Index jumped 28% in Q2. That's one of the sharpest quarterly rebounds on record. Borrowers are back. Lenders are cautiously leaning in, and Trump's tariff clarity, however aggressive, and however bad this may make Europe feel or other countries around the world, it may be helping the market to price risk. The big question, and you kind of touched on it in 2026, is like, when exactly will the sideline capital finally re-enter the CRE stack? And what will it take to get that sideline capital to get off of the sidelines more aggressively?
Yeah, well, I think some of the wheels are already in motion here, right? I think most importantly, from a lending perspective, the debt markets are coming back, and that's obviously crucial for the majority of real estate transactions, whether you're talking about existing properties or secondarily new construction. And so, lending standards by and large have been easing for well over a year now. Very gradually, right, at a very measured pace. So if you look at credit spreads for the CMBS market, for example, those are fairly tight compared to where we were a year, 2 years ago. If you look at short-term or loan-to-value ratios, I should say, those have been fairly conservative, right? At the same time, we've also seen a pricing adjustment, right? Commercial real estate values are well down from the peak several years ago. And so all of the stars are kind of aligning, and it's just taken some time for that to happen. I think, from an interest rate perspective, we've all been kind of waited with bated breath for lower interest rates, and that will help too. I think, there certainly are some question marks about whether the Fed cuts in September or not. I think at this point, probably more likely that we are leaning into a lower rate environment than one in which rates are going to be higher. But even that's kind of a question mark. And so I think, and meanwhile, the backdrop is that fundamentals across most property sectors are pretty resilient, pretty healthy right now, notwithstanding, some temporary softness in the industrial market and perhaps in retail a little bit. But there's a lot to like out there. And so I think that, once we enter a lower rate environment, that's going to help. And so, the debt markets have been really crucial. I think that, equity is slowly starting to come back, right? You're seeing institutional capital start to lean in a little bit more. As I mentioned, I think anytime you have this sort of significant dislocation in terms of pricing, again, thinking about the longer term, there's some very compelling reasons to believe that things will turn up again. So right now, I really think it is the macro uncertainty, the
Yeah.
policy uncertainty that's kind of just keeping things from a stronger recovery. But we're moving in the right direction. Transactions are up on a trailing 12-month basis, 15%. So we're moving in the right direction. And I think we'll see that continue throughout this year and especially into next.
Yeah, look, I mean, the chaos theory has been deeply at play under the Trump administration. The policy whipsaws from one side to the other. That's unpredictable, and banks don't like that. And so, James, let me just ask you here. I mean, if you're an underwriter adjusting a loan term, how do you bake in U.S. policy risk? And what mean by risk is that that's not a comment on whether it's the right policy or not. It's a comment on the policy changing so rapidly day to day, week to week, just like it did in the last 24 hours. How do underwriters bake that in?
Yeah, I mean, the way that I think about it is just given the heightened level of uncertainty that we have from every angle right now. I think, scenario planning is crucial, right? Anyone who says they have a highly confident view of how the economy is going to perform or how real estate markets are going to perform or where interest rates are going to be, I think I'm skeptical of that, right? Because there's just so many different outcomes that can play out. I mean, just take tariffs, for example. We've never had this type of policy in the modern US economy where tariff rates are what they are. And so there's not really a lot to base it off of in terms of modeling what the
Mm,
outcomes are going to be for any of those variables that I mentioned. And so I think scenario planning is crucial. And I think on the margin, whenever you have these kind of tail risks, that is going to lead lenders to be somewhat more cautious. And so, while we have seen significantly more interest from banks in terms of CRE lending, especially the top 25 banks in the United States, uh, while there is more, they're more eager to get back into commercial real estate markets. I think, if the economy starts to turn south and financial markets get volatile, remember that's a bigger problem, and so could kind of slow things down here from a liquidity standpoint. Now, we at Cushman Wakefield don't expect a severe recession. We all know that the economy at this point is slowing down, but that was expected to happen anyway in 2025. And so, I think things continue to keep moving in the right direction from a lending perspective, especially with the banks and life cos. We've also seen private debt funds really ramp up their activity in terms of lending. That's become very competitive and is now about 20% of the lending pool, up from 11% pre-rate hiking cycle. So there's a lot of debt out there, and it's become more competitive. And so I think at the end of the day, barring a severe recession, which at this point seems like a low probability event, things are going to keep gaining some traction in the capital markets.
If you're just tuning in, it's Tariff Week, Liberation Day Part 3, and we're breaking down how the new global trade order could reshape commercial real estate. With us is James Bohnaker of Cushman and Wakefield. James, let's go to a couple of questions from our audience.
Yeah.
Do you have an idea about the effects of immigration policy on the cost of construction?
That is a great question. I have some theoretical ideas. We were going to
Let's hear
focus
them.
on tariffs today, but why not turn to some more policy risk? So we've already seen, I'll just say, as I think most people know, we've already seen immigration into the United States slow down dramatically in 2025 and even toward the end of last year. And the foreign-born workforce in the United States accounted for essentially all of the labor force growth over the previous 2 years. And so with that material pullback, layered on top of that, some of the deportations we've seen and, kind of fear factor of, hearing about people not going to work or to school or whatever because of, concerns over that. I think all those things together is going to be very impactful for construction costs. I don't have a quantitative estimate for you right now, but, in the construction sector, I think it's about 10% of the workforce is
Hmm.
undocumented. And then a much larger portion of the workforce is, obviously foreign-born legal immigrants. And so, both of those things are likely to put upward pressure on wages. And, right now it's not as big of a factor because there's just not a ton of construction activity, whether we're
Yeah.
talking about commercial or resi. But, once we get to a point in the cycle where construction is picking up, I think there's a good potential to run into labor shortages and of course higher cost pass-throughs. So, that's something that we're going to have to grapple with as far as the impacts once we see how immigration and the labor force plays out.
Another question from the audience. What's the probability of a quote unquote big bang of new investment into CRE versus a continuation of the quote unquote long, slow grind we're currently experiencing, James?
Yeah, I think it's hard to say. I think right now it's very difficult for me to say there's going to be a big bang of investment activity. I think we could see it kind of come in fits and starts in that manner, right? The market sentiment right now appears to be gaining momentum. I think that I mean, one thing that could really boost things is, maybe a big Fed rate cut. Maybe one day President Trump walks into the Oval Office and signs an executive order that all tariffs are back to zero. Something like that. But I think barring those kind of events, I think we're more or less in this slow grind period. 2026 is anyone's guess. I think we definitely see more substantial activity once we get to next year. Right now, we're just kind of in that period where there's being a lot kind of thrown at us from a policy uncertainty standpoint. So right now, I think more of a slow grind.
Yeah, I mean, look, and there's been a lot of speculation about a tariff-induced recession, right? And if that were to come to pass, James, I mean, just play ball with me for a second. What sectors of commercial real estate do you think would be most affected by that? Retail, office?
Yeah, I mean, I think the obvious answers are in industrial retail. I think that while the end goal, at least one of them of the tariff policies, is to bring manufacturing and industrial activity back to the U.S., and there have been some commitments for investments in the United States in certain isolated regions and sectors. But if you kind of look at manufacturing activity year to date, we've seen 28,000 job losses. Manufacturing activity overall has been contracting for 5 months. And so I think there really is a lot of concern there within that sector, just with less imports expected to come in. We've already seen that fall off, and so your coastal port markets may see somewhat less activity, and may see some geographical shifts there as far as which regions of the country benefit and which ones kind of struggle a little bit more. So yeah, and then retail. I think we had already seen a lot of evolution over the past year. 2024, we saw you know several high-profile bankruptcies, which,
Hmm.
of course, were unrelated to tariffs or anything, but that's working its way onto the market. And that's going to be a challenge for retailers, right? Consumers are stretched pretty thin right now, and I think something has to give, right? You kind of have to pass those costs along, or look to cut costs elsewhere. And so I think those two sectors are most directly in the crosshairs right now.
It seems like institutional capital, though, is making some moves lately, right? Pensions, sovereigns, credit funds are reengaging, especially in assets linked to AI or renewables and, stable long-term demand. Risk committees are demanding flexibility, shorter hold periods, broader force majeure clauses, and supply chain diversification. James, in your opinion, is tariff sensitivity now a required line in the capital stack model?
Well, I don't know if I would say required. I think it's, the smart way to go about it, because right now, as I mentioned, real estate's been through its lumps over the past number of years. I think that, all this capital has been sitting on the sidelines, kind of theoretically evaluating portfolio strategies, and now is kind of ready to get out and actually deploy that, only to kind of have these new risk factors layered on top of it, and those things are always going to be there. But I think again, it just falls under that macro risk bucket, right? Whether you're talking about geopolitics or interest rate risk or economic risk. And so I think that's, again, this scenario planning is always prudent. And I think, what we're going to see, and we already have been seeing, right, is a focused on, income resiliency from an NOI perspective, right? We're not likely to see a lot of capital appreciation through pricing, at least in the near term, right? So I think those sectors, residential, AI, things that have structural kind of tailwinds, are most going to be in favor and most resilient to kind of whatever's thrown at us from a macro sense, because it's just so hard to predict. I think it's very hard to make um, a play based purely on the macro unless you're thinking about it longer term, right? What are going to be the structural forces driving the economy, driving real estate markets over the longer term?
I know you look at a lot of data, James, and I'm sure you've been studying the last 6 months in particular about everything that's happening economically in the country. What concerns you the most when you're looking at the numbers that maybe people like me can't see because we don't have the same skill set or the same eyes that you have? What concerns you?
Um, I I've got a long list, but I think
We've got a few minutes. Let's get into it.
well, I mean, I'll just mention one thing, and it's because it's such an important factor for the economy, and that's consumer spending. You know, the consumer has been so resilient over the past few years. You know, there's been calls that, debt levels are rising and, this is going to be the moment, inflation, obviously, this is going to be the moment when consumers finally pull back. And I think if you look at consumer spending overall, so for example, in the second quarter of this year, it was grew 1.4% after adjusting for inflation. So, not declining by any means, but for context, it was double that in 2024, 2.8%. And consumer spending is 70% of the economy. And if you think about how many parts of real estate that impacts, right? There's retail, entertainment, mixed use, industrial with e-commerce. So that's really, I think, the thing that I'm most closely watching. We got a reading on consumer sentiment this morning. Still pretty weak. And of course, sentiment doesn't always translate into spending, but it may starting to be. So we've seen a very clear slowdown there. And then furthermore, if you kind of look across the income distribution, there's a big chunk of consumers that do have high debt loads, and their wage growth is slowing, and perhaps we're starting to see a more difficult job market. So that's uh, that's kind of the big thing for me is
Yeah.
just monitoring the consumer.
Yeah, you bring up, and look, today was not a good day for the consumer.
No.
And so, and you're right, there's a big difference between sentiment and what a consumer actually does. The sentiment has been negative for the last 24 months, but the data has shown that, to your point, that consumers have been incredibly resilient, willing to spend money on all sorts of things. If and when that changes, I think you're right that that is something that should be very concerning for the commercial real estate industry. We're running a little low on time, James, but I did want to get to one final question from the audience. In your opinion, how is the chaos in U.S. policy affecting overseas investment into the United States as far as commercial real estate?
Um, it's hard to say with a broad brush. My sense is that investment or interest in investment into the United States is very strong, perhaps even stronger. I think that it all kind of goes back to the sense that the U.S. is the largest market in the world, the most stable. At the end of the day, the dollar, in my opinion, is not at risk of losing its reserve currency status, at least anytime soon. So I think anytime there's volatility globally, investors naturally look to the United States because of those um, democratic system of government, reserve currency, um, and generally just better economic performance, less volatility compared to other parts of the world. And so I think this time's no different. Yes, on the margin, there might be certain investors in
Mm.
parts of the world that, say, hey, I'm staying away just because of all that volatility. But I think by and large, investors realize that there's a tremendous amount of opportunity here. Um, and have confidence in the United States.
James, thank you so much for being here today.
Absolutely, my pleasure. Great talking to you, Mark.
All right, that's it for this week's edition of First Draft Live. We'll be back next week with more from the front lines of commercial real estate. You can subscribe to this show wherever you get your podcast, and you can find every episode on biznell.com. I'm Mark Bonner. This is First Draft Live. Have a great weekend, y'all.